Welcome to All Things Economic. I'm Gil Matthew, Executive Director for the Economic Resource Council of Nevada County. When people talk about the economy, things like interest rates, inflation, recession, one institution comes up again and again, the Federal Reserve. You'll hear things like the Fed raised rates or markets are waiting on the Fed. But what exactly is the Federal Reserve? And what does it actually do? Why does it matter so much to the economic world? The Federal Reserve, most often just called the Fed, is the central bank of the United States. It was created in 1913 after a series of financial panics showed the country needed a more stable and coordinated banking system. The Fed is not a traditional government agency, and it's not a private bank either. It's a unique hybrid system. It has a board of governors in Washington, D.C., 12 regional Federal Reserve banks spread across the country, and oversight from Congress, but with independence from day-to-day politics. That independence is key. It allows the Fed to make tough economic decisions without worrying about election cycles. The Fed has three main responsibilities. First, monetary policy. This is the big one. The Fed works to keep the economy stable by managing inflation, prices rising too fast, employment, keeping people working. Economic growth is its main tool, with its main tool is interest rates. When inflation is high, the Feds raise interest rates to slow borrowing and spending. When the economy is weak, it lowers rates to encourage loans, investments, and job creation. This affects everything from mortgage rates and car loans to credit cards and business expansion. Second, banking system stability. The Fed acts as a regulator and a safety net for banks. It supervises major banks, sets reserve requirements, and provides emergency lending during financial crisis. During the crisis like 2008 or the pandemic, the Fed plays a critical role in preventing panic from turning into full-scale economic collapse. The third responsibility is the payment system. Behind the scenes, the Fed helps money move through the economy. It processes trillions of dollars in transactions every day, checks, electronic payments, and transfers between banks. If the Fed stopped working, the financial system would grind to a halt. The Fed's decisions ripple through the entire economy, often before most people realize it. For households, the Fed policy affects mortgage payments, rent pressure, job availability, credit card, and loan costs. For business, it shapes expansion plans, inventory, and investment. In fact, the U.S. dollar is the world's primary reserve currency, which means the Fed's actions don't just impact America, they affect global trade, capital flows, and foreign economies. Because the Fed is so powerful, it also is controversial. Critics argue it can react too slowly or too aggressively, fuel asset bubbles, hurt savers when rates are low. Supporters argue that without the Fed, economic downturns would be deeper, banking crises more frequent, and inflation harder to control. Both sides agree on one thing: what the Fed does matters a lot. So the Federal Reserve isn't just a distant institution for economists and bankers. It quietly shapes the costs of money, the health of the job market, and the stability of the entire financial system. You may not feel the Fed every day, but when it moves, your economy moves with it. So again, I'm Gil Matthew with the Economic Resource Council of Nevada County. And until next time, be well and thrive.